Welcome and thank you for showing up for this accounting and bookkeeping tutorial. We're first going to start with the accounting equation. Some basics. What is accounting? Accounting is a set of information systems that organizes, maintains, records, and analyzes financial activity. It is also considered the language of business. Businesses use accounting to show what's going on at any point in time with them, and we use a common denominator, which is money, and we try to show any transaction that has happened on the business and how the business has been doing through a series of books and financial statements. There are three main accounting areas. We have public accounting, where you see auditing, consulting, advisory, income tax preparation. Usually a public accountant does not work inside the company or that's inside the business. What they do is they help the business either with a specific accounting project or perform some auditing to comply with the law, or help them with their income tax preparation. Private accounting is where you see teams of accountants or accountants that work at a business, and they're there to record transactions, to prepare reports for the interim reports for the business, and most of the work that is done in-house is done by this private accounting team. Government accounting works in the same way as private accounting, but for government entities. So in the government accounting office, you will see people preparing financial statements, tracking transactions, reporting budgets, and being able to analyze the information that they have gathered from the government's dealings and put it in a way that is organized and have the ability to be analyzed in the future. Who uses this information? In a company, managers have the ability to use this information to make everyday business decisions as far as, well, are we going to hire more employees? Are a certain product or service that we're providing making us any money? What products should we undergo in the future? What products should we just let go because it's not something that is giving us any money whatsoever? They're also there to answer a very important question, which is, are we making money? Should we still be here in business? Are we actually making any progress here? Outside stakeholders can also see this information for various reasons. Investors have the ability to use this information to see if the company is worth their money, if it's actually doing what it's supposed to be doing, and if it shows some promise. Bankers and suppliers are always working with businesses to either provide loans or to provide supplies for the business to be able to run on credit, meaning you're going to have to pay them later. And in this case, seeing the accounting records allows the bankers and suppliers to understand whether or not they're going to get their money back. Customers can also see the accounting books or the accounting records to see if in fact the business is able to provide the service or product that they promised. This is not a great issue if you're just going to a place where they're going to hand you something. So you go to a pizzeria, you order from them a pizza, and then you come and pick it up, and that's fine. You probably don't have to see the financial statements of the pizza shop to buy a slice of pizza. But if you are a public school that is going into business with the pizza shop to provide pizza for 300 students every day for the next 5 years, then making sure that the accounting records and the books and the business itself is sound might be a good idea. Government also uses this information to make sure that the company is acting ethically and lawfully. Accounting records are used to make sure that the business is paying their income taxes, and that is showing really how much money the business made. Accounting records are shown to make sure their businesses are not involved in money laundering transactions. Accounting is also shown to make sure that if the business is not just one owner, but it's many owners, millions of owners, which is the case with public companies that you see traded in the stock market, we have to make sure that the board is not taking their money home, or that actually the board is doing what they have to do at the best of the interest of the company. So accounting is actually based on business transactions. And a business transaction is any activity that affects what a business owes, as well as the ownership of that business. What a business owns is defined as an asset. And an asset needs to meet two different requirements to be considered asset. The first one is that it must be owned by the business. The second is that it must have money value. Some examples of assets in a business would be cash, accounts receivables, office supplies, furniture, equipment. So if you go to the Apple store and you see a box of an iPod, Apple considers that an asset for them because they own it and it has some money value. If you buy the Apple, if you buy the iPad, then this becomes your asset. It becomes something that is yours, and it becomes something that has money value. It has money value to you. Assets are usually divided into 4 different categories, and these 4 different categories are also can give the person seeing the accounting books an idea on how liquid or not these assets are. Current assets are the most liquid assets, which means that you could turn them into cash fairly quick, or they are already cash. So current assets you could turn into cash in less than 1 year. We also have investments. Investments are long-term assets that are not used in normal business operations. Property, plant, and equipment are long-term assets that are often used in business operations. So if you have a computer, or if you have a pizza maker or pizza oven, that equipment has value. However, we do not expect to get rid of that equipment within a year. The equipment is used most of the time for the production of the product that we're selling or the service that we're providing. And then we have intangibles, which are assets that have no physical substance but still have value. An example of that would be the brand of a business. Starbucks. Starbucks sells cups of coffee. You can find a cup of coffee everywhere, and you probably could find a pretty good cup of coffee for a third of what you pay in Starbucks. But you're paying Starbucks because of the brand Starbucks. And even though we don't associate that brand with having value or physical presence, it does. We put a sticker in front of a cup, in front of a white cup that says Starbucks, and people know that it has a brand. Automatically we assume quality, or we assume a certain level of care when the product was made, or we assume that the product is something that we are going to like. Now that we have talked about assets, let's talk about few accounting principles. The first one is the monetary principle. And the monetary principle tells you that all business transactions are have to be recorded in terms of money. So if you have 7 apples, you cannot put 7 apples as assets. You have to put $7 as assets. Asset that you have must be recorded in terms of money. Also, we have the cost principle, and what this means is that you should tie up to that asset also the value of their transportation costs, installation charges, etc. So if you installed a new pizza oven and the value of the pizza oven was $5,000, but you have to pay $300 for shipping and installation, the value of that pizza oven is not $5,000. The value of that pizza oven is actually $5,300. We also have the business entity concept, and this is something that is very important because it's something that a lot of small business owners have problems with identifying. An asset that a business owns must be separated and apart from the owner personally. So even though we know that this computer that is in the office, or this cash register, and the money that is in the business, in the pizza place, is the owner's, these, for accounting purposes and for actually legal purposes, are separate entities until the owner decides to take the money out from the business. So the fact that the business has $100, unless there's a formal process for the owner to take $100 out of the business, this money belongs actually to the business, not the owner yet. So now that we talk about the owners, let's talk about the owner's stake in the business. The proprietor is the person that contributes the assets to the business in the beginning, or while this is functioning. And this is called capital or equity. If you open a bookkeeping business and you contributed $3,000 in cash, $1,200 in office equipment, $500 in supplies, and it came out to a total of $4,700, this means that the total money that you have here, the business owns $4,700, and the owner owns in the business $4,700, when there is no other thing than the assets of the business and the capital of the owner. It is set to believe that whatever assets are in the business are the same as the ownership of the business. In this case, if the business makes money, and let's say that the business all of a sudden has $4,900 in assets, that means that the capital in the business also is $4,900. Keep in mind that whenever we have something here that is called an equation, and this means that whatever number is here must be the same here. If the business loses money and it's now $4,300, there's really nowhere where the owner could get now $4,900, because there's no $4,900 in the business. So in this case, the owner loses the money that the business loses, as well as the money that the owner makes the money. So what if you borrow money? You are working on your business and you decided that, it was not enough what you had in there. Many businesses need to borrow money in order to conduct business activities like buying expensive equipment, paying employees, or having cash at hand. Money borrowed is actually considered what is called a liability, just like it's money that you owe to anyone, or the business owed to anyone, let's say. A liability is assets of the company that is owned by its creditors. So if you borrow $1,000 from the bank and now you have $1,000 more cash, that $1,000 is actually owned by the bank, even though it's part of your business. If you have $4,700 that is owned by the business, and you borrow $1,000 more from the bank, that doesn't necessarily mean that you, as an owner, have more money. It does mean that the business has more cash now, so it has $5,700, but that didn't make you, as an owner, any richer or poorer. This is how the accounting equation is born. The accounting equation allows us to see how much money the business has, or right now, in assets, and how much money from that is actually ours, and how much money is actually the creditors or the bank in this example. So we could use the accounting equation to express that the business has $5,700. Out of that $5,700, $1,000 is owned to the bank or to the institution that we borrow the money from, and the rest of the money is actually owned by the proprietor of the business. So why do businesses exist? Why is it that you think that you should decide to open an accounting firm or a pizza parlor or a business anywhere? This is kind of like a obvious question, is because we want to make money. So businesses exist to make money or to make a profit, and ultimately that profit or that money is going to come back to the owner. Money that is made from business operations is called revenue. Often revenue is recorded as an increase in cash, meaning if we made money, we have more money in our pocket, and it's also recorded as a increase in capital. Be very mindful of this. Money made from business operations is called revenue. And revenue is often recorded in the following manner. There will be an increase in cash, meaning because there was revenue in the business and that revenue made us more money, that means that the business owns more money. So capital usually means business owner. Assets usually mean company. So in this case, if you receive revenue, that is often recorded as an increase in an asset, often cash. It may be that it's somewhere else, but it also means an increase in capital. Often a business to make money needs to actually spend money, and the cost of doing businesses are considered to be expenses. Expenses are different from revenue. Just like if you spend money, you have less money in your pocket. A business, when it spends money, it has less money in its pocket. That is less money in the owner's pocket. When the business loses money, the owners loses money. When the business makes money, the owners make money. There's the possibility of the business owner taking money out of the business, and this is called a drawing or withdrawal. So whenever you see a drawing or withdrawal in the business, it will be almost the same situation as if it was an expense. However, this is not an expense because we're not making any operation. This is just more the ability of the owner to say at some point in time, I want some money out of here. Keep in mind that in small businesses, this happens more often, but in other bigger companies, this happens to something called dividends. So if you hear the word dividends in the news or in the stock market, or if you hear that Apple declared dividends of $2 a share, all that means is that if you are an Apple investor and you have 10 shares of Apple and $2 per dividend, as long as you met the dividend cutoff date, you're gonna get $20 from Apple as a business owner. Revenues, expenses, and drawings all affect capital, and these are called temporary transactions. What that means is that we often are not going to see that in the accounting equation, because all they do is just affect capital, so they're all parts of capital. However, it is necessary for us to be able to identify each one of these and how they actually affect the business. So right now we have talked about different categories: assets, liabilities, and capital. And all these categories can be affected by business transactions. It is the duty of the accountant or the accounting team to record these transactions as they affect this category. And because of that, each one of these receives an account. So just like if you had a check register, whenever you take money out, you take it out of the check register, or whenever you put money in, you put it in the check register, or you see your online statement and you see that happens. It's the same thing that will happen in the accounting books. Every time there is a transaction, you have to actually put in that this transaction occurred. And we're going to use accounts, or we're going to use accounting systems to be able to show how these transactions happened. So just to summarize what we talked about, accounting is the art of organizing, maintaining, recording, and analyzing financial activities. Accountants record how business transactions affect assets, which is what we own, or which is what the business owns, liabilities, which is what is owned by a creditor, and capital, which is what the proprietor of the business owns of the business. The accounting equation is represented by assets equals liabilities and capital. Remember that whatever happens on this side must also happen on this other side. Thank you, and we'll see you on the next chapter.